Hello, Seth. How are you?
Hey, how's it going?
I'm going great. Now that I finally managed to pin you down to an interview, I can
My
ask all
pleasure.
my finance related questions.
Yeah, I will. I will do my certainly do my best to answer them.
Okay. Now that could you please introduce yourself a little to the audience?
Sure. My name is Seth Levine. I'm a professional investor. Been doing this for almost 20 years or so. But my kind of public face here is as the creator of the Integrating Investor, which is a website, kind of a blog that I started. I've been running for about 5 years or so. It's kind of my own my own vehicle for really working through a lot of investment ideas that I have. Just being in the job for as long as I've had, I've taken a lot of different perspectives, and I found that, quite frankly, things that I thought I knew, I actually didn't. So I used to blog to kind of work through all those issues. And because I am a professional investor, I should start off with a some kind of disclaimer. These are just my personal views. They don't reflect my employers or anything like that. This is not investment advice. Do your own work before you're going to invest. Like, I'm just speaking, off the top of my head here. So, don't take any of this as as actionable.
Right. That was the disclaimer, everyone. Cannot sue us for anything on this podcast. But yeah, you mentioned that you've developed over the years, or you found over the years that you have integrated some, let's say, some things from philosophy to help you uh, with your profession. Would you like to speak just a little bit about it, not as a recommendation, but just like as a little bit about that?
Yeah, absolutely. So, my sort of, I've gotten very into uh, kind of philosophy, and really I look at almost my view, sort of my evolution of investing, very similar to sort of my evolution on philosophy, and wh- and what I mean by that is, I as sort of a younger, kind of an early 30s person, I was introduced to philosophy, or really, I came to philosophy, and specifically, Ayn Rand's philosophy, through a friend of mine. I was early in my investing. Well, throughout my investing career, I sat in a seat and I had sort of a view. I was being taught how to invest, but as I was kind of looking out in the world, I was like, wait, like, what is going on here? So anyway, long story short, I read this essay, "Philosophy: Who Needs It," by Ayn Rand, and basically a huge light bulb went on in my head, where it was, hey, I'm a human being. Human beings need a philosophy because we act on volition, right? Like, human beings, we're not predisposed really to anything, but really the ideas in our head are what drive us, what motivate our actions. And I thought, huh, yeah, it's kind of almost like a computer, where like you have an operating system in a computer that sort of makes all that makes it all work. And I thought, hey, that's new to me. I really never thought about that. I have this like conscious, I have this conscious kind of philosophy that, or subconscious philosophy that I'm operating on. Wouldn't it be good if I knew what those premises were? So, long story short, that kind of drove me down into philosophy and just really my own psychology, and trying to untangle and tease out what are these sort of subconscious premises that my body was, that I was acting on, as a human being, and really consciously define that. Now, something similar happened in that in my investing career. Looking at like kind of 2008 or so. So this actually, you know, precedes my sort of my philosophical introspection. I saw a lot of crazy stuff happening during the financial career. I had a front row seat for it. I was working at one of the at a prestigious investment bank on Wall Street on a bond trading desk. Like, I literally saw a lot of the financial crisis unfold in real time, like at ground zero. And then, as a consequence, I saw all the all the central banking response to that. And as I saw the response to that, I sort of had some ideas of what would happen, but I started reading a lot of others' views of what would happen in the market. So over like a 5-year period called 2008 to like 2013, I started to develop all these ideas. I thought, what the central banks were doing by directly intervening in the investment markets would lead to a lot of bad stuff. I thought it was going to be, hyperinflationary, inflationary, if not hyperinflationary. So like collapse the currency. I thought we were going to see stock market collapses. I thought we were going to see bond market collapses. And all these things, and some of them I come up with myself, but a lot of them I took from popular media or maybe not necessarily popular media, but other kind of professionals, their opinions. It kind of resonated with me. Like I thought gold would go through the roof, for example. So I sat in my professional investing seat. I was now with a different firm, and I had all these ideas. And quite frankly, over the next 10 years, none of them really came to fruition. None of them played out. And earlier in kind of the 10-year process, I had asked myself, all right, what is going on here? Right? I was faced with a dilemma. Reality was not verifying my ideas. So I basically had two questions. I could, there were two paths I could go down. I could, one, change my ideas or really explore my ideas, or I could just kind of ignore it and evade it. So I started to explore them, and I did that kind of with the help of this blog and, the Integrating Investor. You could find it at integratinginvestor.com. And I really used this to really tease out a lot of my ideas. And what I found by going through this process, which is very similar to what I found going through the process of philosophical introspection, is that some of those ideas weren't as clear to me in my head as I thought. And I've really just kind of gone down this journey, and it's a parallel journey with my philosophical path of kind of growing, and I believe kind of better identifying things in my head and things in the investment markets to lead to better success in living and investing.
And how have you been finding that journey so far?
It's been fascinating. Both on kind of in both journeys. I mean, I'll talk maybe just about the investing journey first, but for example, like I'll look at my first article on my website and kind of my most recent one, and they both deal with this idea of central banking, and it's pretty interesting just how much my views have changed. When I started writing, and I started writing in 2008, so this is still some years after I started the exploration process into investing. I really had a very negative view of central banking, and I still have a very negative view of central banking, but I had a very, what I'll call, conventional view of central banking. Like, for example, I thought central banks were printing money. I now realize through a lot of work and a lot of writing that central banks don't print money, for example. Now, that is a very controversial statement that I said. Now, just because central banks don't print money, in my view, doesn't mean that central banks aren't harmful for the economy. So I just think the central banking impact is very different than what people think it is. It's still negative. And quite honestly, if you look at what a bank is, it's actually completely integrated with what banks do.
I see.
Yeah. So like, for example, right? So, and this, coming to this view, and I've written about this in a number of articles on my site. They are not sort of in one cohesive article, although you can find something called "To Fight the Fed or Not," which was really my first sort of exploration into this in a longer format piece. I think it's maybe 3 or 4 pages, done for in a friend's publication. But I had to go back and basically redefine money. So, maybe I'll tell this journey. Basically, in 2013, I'm looking at, it was the 100-year anniversary of the Fed, and it was really my first exposure into seeing critiques of the Fed. I had been working on Wall Street, at that point for about 9 years or so, and Wall Street had a very, conventional view of what central banking does. It still does have
Can I
kind of a
can I
lot
ask a
of
quick
those.
question?
Sure.
Doesn't Wall Street to some degree like the central bank, or is it not the case that certain investors like it that the central bank does certain things to calm the markets or to ease certain tensions in the markets?
Well, Wall Street's a very big place, and I think you find people on both sides of the aisle. But I think what most people try to do is just acknowledge, they almost take a more concrete, narrow view of like, this is the world in which we live, right? We live in a world of central banking. How are we supposed to operate in this world? And I think that's, I think that's very integrated in one sense, because again, they have a job to do, which is invest in the world as it exists today. But a lot of times when you move into that policy, as you slide into the policy type of discussions, I think it's very counterproductive. So now
So if,
again, you're prescribing, you're saying like what a central bank should do, when really, as I see it, it's perpetuating the problem.
okay,
So for example, maybe a long story short, so how I see, I basically I came to this view of central banking, or I was introduced to a critique of central banking, which I had never been critiqued, which I never really been exposed to. Then I actually learned that like there used to be a world without central banks, which literally just sounds so silly now, but it kind of blew my mind at the time. That there was a world of sort of just banks without a centralized bank, and I started to kind of research that a little bit more. You have, probably the foremost experts on that are George Selgin and Larry White. Their work, and they blog. They're professors, but they write at altm.org, which is the site alt-m.org, I should say. And I just started looking at this world of quote unquote, of more of decentralized banking without a central bank. And then I started to realize, all right, like then I started go down this wormhole of money, because once you start looking at banks, you have to look at money, because if you want to understand, understand banking, you have to understand money, because banks operate in the world of money. So I actually reformed an entirely different view of money. And from money, I've sort of built back up my understanding of banking. So it's pretty interesting. So I was looking at the markets, and then I was looking at markets from the perspective of central bank intervention. So then I had to understand central banks. But to understand central banks, you had to understand banks, because central bank is a specific type of bank, right? It's a class of bank. But to understand banking, you have to understand money, because banks operate with money. And understand money, I had to literally go back and understand what is money trying to do and what are individuals trying to do. And then from there, I was able to rebuild up my understanding of banking, right? And then rebuild up my understanding of central banking, and then rebuild my understanding of investing. So it very much is, a parallel with philosophy, where you're going down. If I don't know if your listeners are familiar with the concept of the conceptual hierarchy, which is again described by Ayn Rand in her epistemology. You basically are building concepts from percepts, in kind of a chain of more, in kind of increasingly complicated fashion. And that is exactly what investing is. So in order to really understand investing, you have to really break down each concept until you get down all the way down to the perceptual level. And that is a technique that I learned from philosophy. So
mm-hmm.
from doing all this is how I've really rebuilt my entire view of money. I rebuilt my view of banking. I rebuilt my view of central banking, and I've rebuilt my entire view of investing.
So do you have a theory of money?
I do, and so really, again, nothing is new under the sun. I surprise or not, surprising or not, I actually find that Aristotle has the best identification of money. He
Wow,
basically
I have to hear this.
yeah.
If it's all the way back to, go ahead.
No, so Aristotle actually talks about money in his in his writings, and my interpretation of the of the translation is that he views money as just a common measure of value. Um, basically, it's a way to put things in common common terms. So money has many definitions by many different people, and quite honestly, they're all kind of conflicting and they're all kind of confusing. But if you go back to Aristotle, and I found a quote right here that I'll read. So Aristotle, to quote him, says, "Money, then acting as a measure, makes goods commensurate and equates them. For neither would there have been association if there were not exchange, nor exchange if there were no equality, nor equality if there were no commensurability. There must then be a unit, and that fixed by agreement, for which reason it is called money. For it is this that makes all things commensurate, since all things are measured by money." So basically what Aristotle is saying is that money puts things in common terms for each other. And that just makes a ton of sense with me. Because if you think about it, because there are other views of money, but when I think about what these other views of money are, they really sit upon this Aristotelian definition. Because some common views are money. Money is thought to be many different things. Money is, and there's the big four items that people assume they are. Really, it's three, but basically, it's one, this common unit of measure, right? The Aristotelian view. It is a medium of exchange that is out there, and also people think that it is a store of value. And there's also another one, fourth, which is a standard measure of value, but that's really just an application of a common measure of value, right? It's basically, the standard really comes out of that common view. But if you think about it, right, like this view of medium of exchange and this view of storage, it starts to confuse things, because then if you're like, all right, if we define money as a medium of exchange, things get very confusing, right? So what then would be money? Like, it's hard to identify money, right? It's hard to perceptually identify money if you think that it's a medium of exchange, right? Because we use gold, for example, cash as a medium of exchange, right? So cash, physical dollar bills, for me, I'm based in New York, if you can't tell by the accent, that seems to be money. But, most of my purchases are done by credit cards. So are credit cards money, right? Some people say, yeah, of course credit cards are money. Okay, well, credit cards are money. Then what is my whole credit balance money, right? If we want to count money, is the whole credit line that my credit card company extends to me, is that money? Or is it just, is money just the amount of transactions that I have outstanding? And what people are like, oh, geez, I don't know. What about checking accounts, right? What if I write checks, right? So are checks money? People are like, oh, of course checks are money. Okay, well, it's my checking account money? Or what about if I can, again, it's like, it starts to get very muddled. And then you'll hear people say, well, gold is money, right? A lot of people think that gold is money. But gold is not a medium of exchange. I can't buy anything with gold, right? If I walk into a store with gold coins, they're going to kick me out, right? They'll be like, you can't, we can't, pay for this. And then you have things like people think, then there's a whole, there's a commonly used metrics of money like M1 and M2 in economics. And M1 and M2 really come from a Milton Friedman definition, which are just, it's an aggregation of various bank accounts at like commercial banks. So they'll go and they'll add up all the currency in circulation, and then they'll look at checking accounts, and then they'll look at demand accounts. But why are you going to look at demand accounts? And then you reach in, you kind of go into the institutional world, of investing and the financial system, and you find that institutions use bonds and derivatives as mediums of exchange. So then you have a whole class of people who think, well, bonds and derivatives are a medium of exchange. But what about central banks too, right? It's very commonly believed that the Fed prints money, for example. Well, the Fed doesn't do with any of the things I just said. All the Fed has are these things called bank reserves. And that's something completely different. Those aren't minimum exchanges. No individual has access to a federal bank reserve. Some commercial banks do, but not all finance companies do. So how do you start to detangle? How do you start to identify money in the world? And I'm sitting here, I'm like, man, how do we identify money in the world? And to me, that was just a glaring problem. And kind of going through and researching it brought me back to, Aristotle. Because if you look at Aristotle, he says, money is just a measurement concept. In other words, money is just a way how we can equate economic value, and put economic value in common terms. And to me, that just like rang a bell. And I think of it in like an analogy, right? And the analogy is this: money is to length as inch is to dollar, right? Money is to length as inch is to dollar. And so when we think about length is a measurement concept, right? It measures spatial. It's the measurement concept for spatial distance, right? So you have to have 2 points that exist in space, right? So you need 2 points. They have to exist, right? There's no measurement of space if it doesn't exist. So you have 2 points that exist, and then you are trying to apply some standard, in the case of the analogy, an inch, to it in order to measure it. So we have money. So we have length, which is the measurement concept that equates spatial distance, puts spatial distance in common terms for people. We have the concept of inch, which is a standard by which we can grasp. It's a perceptual standard by which people can grasp spatial distance. Well, money is the same way. Money basically puts economic value in common terms. Now, that's kind of vague. Like, what is economic value? And really, like, economic value is really anything that humans need to survive or thrive. It could be food, which is like very basic to survival, or it can be art, right? Which is something that helps humans thrive. And money is a way to put it in common terms, right? Like, how do you know how much? Like, how do we measure the value of food? Well, we say, go walk into a grocery store, for example, and we say, all right, well, this banana costs $1. It's the only way to talk about it, right? Like, we know the banana is valuable, but we can't quantify it. So really, the money, how I see it is everything that exists in the world that has value to human beings in terms of their survival and thriving, which is basically everything, can be put in money terms. But you need some sort of unit, called a dollar, for example, to actually ground it into reality, right? To make it graspable to our brains, to put it in some sort of standard, just like an inch does the same thing for spatial distance. So money is really this concept of measurement, this measurement concept. And then everything else that we do is some application of money, right? So cash, coins, gold, silver, credit cards, checking accounts, bonds, credit derivatives, central bank deposits, cryptocurrencies. All these are applications of the concept of money. And once I started doing that, the whole world started to make sense to me. So I know that's a lot there. It's kind of abstract. Happy to walk through that a little bit more, but that is how going down this wormhole of investing and taking this philosophical approach of taking concepts and trying to bring them down, ground them into the perceptual, back down into lower level concepts and eventually back to the perception, has helped me sort of understand the investing world better.
Okay, so let me see if I can ask 2 questions. So is it the case that when we say this banana is worth $1, is it worth is the application in the sense that we want to exchange it? The worth is for the purpose of exchange, or the worth is it for the purpose of us enjoying it, or the value it is to ourselves? Because I would imagine that could vary a little bit. And the second thing is, sorry, and before you answer, and the second thing is,
please.
Is it the case that financial markets greatly complicate this process. So, for example, I'm aware that in the Great Depression, there was an issue that the central bank didn't withdrew a lot of cash from the economy. And it's a little bit difficult to say this banana is worth $1, but when we don't have money circulating, I'm not trying to complicate it necessarily. Sorry,
yeah,
go
I
ahead.
think I understand where you're going, and I'll take them in order. So the first question is why. What do we need this concept of money for? Why is money? And is it just for exchange? Is it just for storage? No. And the answer is no. We need this concept of money for living in general, because ultimately, all of our actions, every human action that we take, can be put in money terms, right? Because money comes down to is a way to measure how we each live our life. We all, as a human being, we all need to produce to live, right? If we just laid down, on the ground, and took no motion, we would die, right? We literally we need to expend energy to produce a breath, right? To produce the oxygen, extract it out of our air, right? We need to take it in through our lungs and do biological processes and expend energy just for the process of living. And that energy requires sustenance, right? So we have to even go and get food for ourselves in order to live. And that process of food is an economic activity. We produce economic value, even if we're not going to go to a grocery store and buy it, even if we're not going to go, and farm it ourselves. Let's take the most basic activity that we can do to get food, and it's like go forage for food. Like that still requires human action, right? That still requires getting up, taking a step, identifying mental energy of identifying something as food or as poison, right? That is actually a productive action on itself. You have to pick it up and you have to like physically put it into your mouth and physically chew it, or swallow it, right? So the very simple, every act of living is an act of economic production. So everything from exchange to savings, right? Savings is an important concept for human living too. All require this concept of money, because we need to think about how much energy am I going to expend in order, if in this moment, in order to live. Now, the second question of how can we think about money in this world of central banking or financial markets where we have central banks? And quite honestly, I think the worst thing that we have done to ourselves is really go down this path of fiat currency. Right? I think fiat currency is extremely harmful. Now, I think it's harmful for different in the same reasons that people think. One, now there's this concept that the currency supply can be expanded, and that is 100% true. Now, notice how I used the word currency supply and money supply. When we look at throughout history and we look at how sort of, inflations throughout the world, what we find is really the government authorities have expanded the amount of currency, but they have not done anything to expand the amount of economic production throughout the world. So they've debased the amount of currency. But think about that for a second. That means that currency and money are not the same thing. That means that currency and value, that currency and production are not the same thing. That means they are separate concepts. And that is precisely what makes me understand, what helped me understand this concept of inflation and monetary debasement. And when you go, so for example, when you live in the US and you have, a dollar, 20 and 2/3 dollars defined an ounce of gold. When the government comes in and changes that to 35, they've basically, changed the measurement standard of what a dollar is. And you could see how that's pretty bad, right? And really what you have is a revaluing of all assets to the new standard. It's as if you said, okay, an inch corresponds to this much and you would have to point to it, this perceptual amount of physical distance, and then you change it. Well, then everything measured in inches then changes. But now we live in this world of fiat currency. And in fiat currency, there actually is no monetary standard. You can't say this, and you have to point to something, constitutes a dollar, right? This constitutes a pound. This constitutes a euro. Back under a gold standard, you could at least say this and point to a certain amount of gold, right? This constitutes what a dollar is. And why is that important? Because this amount of gold, we can relate to back to human productive activities. Like we could understand, we could ground it in the perception of what it takes, how much human effort and time and know-how it takes to produce that amount of gold. Now, I'm not a gold miner, but I have some sense like that's not easy, right? Like I need stuff, right? I need geological understanding. I need equipment. I need, I need markets. I need, all sorts of things. So now I could say, all right, well, that sort of lump of physical stuff over there is about $1. So now I can take that lump of physical stuff and put it back to the banana, right? I can relate that back. I could put the banana and the gold in commensurate terms, just like Aristotle suggested, right? There is a common term, and we call that term, dollars or euros or pounds, right? When there is, say, a gold standard, a physical commodity standard, or it doesn't have to be a commodity, but a physical standard. But now we live in a fiat currency world. You can no longer do that. There literally is no definition of a dollar. There's no definition of a pound. There's no definition of a euro. We actually don't have any, we don't know what things truly cost in the world in terms of human effort. Now we use this idea of, and I think it's very valiant effort, and it shows the ingenuity of human ability, and it also shows the need for having this perceptual monetary standard to put things in commensurate terms, as Aristotle noted, because we use things like CPI now to define this concept of inflation. So we have baskets of goods and services that we try and monitor as proxies for physical standards of this physical standards of currency that we actually need to put goods and services in commensurate terms. Now, there's a lot of problems with this. And the main problem is that the prices of goods and services change all the time, and they should change all the time because human productive capabilities are changing all the time. They change all the time because, goods and services change, the quality of goods and services change. And quite honestly, when you have a productive economy, productive economy, right? We have a productive economy. We should be getting more productive over time. In other words, the price of goods and services should fall and their quality should improve. And we see that all the time. So you should have fallen prices. You should have, to quote the economists of the day, deflation. That should be the normal state of the world. But in some sense, that has a bad connotation because of the way that we're using the concept of inflation today in a fiat currency regime where we now define CPI as inflation. So things are getting all messed up because we have this really bad definition of money. And that flows through into investing, that flows through into central banking, that flows through into policy in a very complicated chain. But until we've defined money correctly, as Aristotle said, we cannot see this problem of monetary definition. We cannot see things like inflation. We cannot understand things like central banking. And we cannot understand things like investing because of this long conceptual chain that all rests upon the proper concept formation.
Okay, that was actually quite clear for someone who doesn't fully understand it.
I'm glad because it's super complicated, super abstract, and it's really hard to really concretize these concepts because of two things. One, because of how complicated it is, but two, we hold these, we all use these definitions in our mind. Like even my like infant kids, or toddler kids can understand money. Like, right, even they know like money is like was the key to getting like certain things. So we form these concepts really early on. But if we don't form them correctly, we could see how we just compound they compound the mistakes. So we have these notions, and it's really hard to go back and reform these notions unless like you're really motivated to kind of rethink, everything that you believe in the world. And quite honestly, like going back to the blog, like that is really how I started my blog, where I was looking at the investing world and saying, these things don't make sense.
Can I
That's a
can I ask a
problem.
can I ask a point about the deflation point that you
Sure.
made? So I do understand that the inflation is measured to the CPI basket, and as a principle, humans, innovate and become more productive over time. So in theory, things on that basket should go down in price over time. But also, and certainly some things on that basket do go down over time. So markets, just because they're more productive over time, should have a deflationary effect based on the fact that we count it through the CPI basket.
Yeah,
Does that make sense?
that makes sense. Yeah, 100%. But there are other problems with sort of that basket too, and besides just the inflationary, deflationary. Like, how do you define those baskets? Right now, the baskets are defined for the quote unquote average person or something like that. But that doesn't make any sense, right? Because what constitutes maybe my cost of living, for example, is going to be dramatically different than what constitutes your cost of living, right? Or what someone living maybe in the woods. Like I live in New York City. I for example, like I don't need cars, for example. So like my cost, my average spend for on a car is going to be significantly less than the average spend for a car who lives in like rural Kansas or something like that. So these baskets are education, right? People are not the same. People, you know, people have different values, and to sort of put this common value metric on someone, I think it's just a bad process. Even if you're trying to do this, what I think is a commendable job of trying to define what we spend our money on, what we how we on things that we live by. Like we just people don't have the same average expenditures. There's no such thing as an average person, so there's no such thing as an average expenditure.
I think you just ruined it for all economists now, because basically this is their bread and butter. Like, yeah, go to like one person in 15 different cities, ask them what's the top 15 things they buy, and now we can run the economy based on our metrics. What's the problem? We just do an average.
Yeah, and I think that's a problem. Not just all economists. I think it really is a specific class of economists. I think it's a problem with macroeconomics specifically. If you think about what macroeconomics is, macroeconomics is really, it's descriptive, right? It's a descriptive science, because macroeconomics is really just aggregating microeconomics. It's very similar to how society is really just an aggregation of individuals. Macroeconomics is really just an aggregation of microeconomics. So yes, we can measure macroeconomics, measure things in macroeconomic terms, but you can't really prescribe things in terms of macroeconomic terms, because there is no such thing as the macro economy, right? Like there's no entity that is the macro economy. The macro economy really is just an aggregation of individual microeconomic existence, right? It is an aggregation of actual things in the world that are operating in an economic sense. So you can certainly describe things in terms of macroeconomics, but you cannot prescribe things, right? You cannot kind of push things down in a top-down fashion, because you are doing things because the individual constituents act differently than the aggregation of the whole.
I think the problem is that they kind of, I agree with you, but I think the problem is that they kind of do prescribe, because even the notion of a market failure, the notion of, let's say, income inequality. Those are prescriptions. Those are pointing out there's an issue with the macroeconomy and prescribing like these bullet points of how to address it. So I think in and of itself, like that particular science comes with and how to fix it based on a certain standard.
Well, yeah. Well, what I would reply to that is, I think it's misapplied. I don't necessarily think macroeconomics as macroeconomics is flawed, because again, I think you can use it in a descriptive fashion, but exactly what you're saying, to use it prescriptively, to say, oh, this is what we're observing, so hence this is what we want, right? If we're looking for some kind of central planning, you cannot sort of push that down, because again, let's say you could observe, for example, income inequality, without making any sort of moral judgment associated with that. However, you cannot say there's income inequality, I want to make it zero, here's a prescription for it, because that just completely violates the relationship between macroeconomics and microeconomics, right? The concept only flows one way. You can only build macroeconomics from microeconomics. You cannot build microeconomics from macroeconomics. Now, it's true there are incentive structures, but you're still applying incentive structures on the microeconomics. So it's a very perverted way of kind of using kind of the data. And I think, we've seen, I think, to your point, like the application of macroeconomics into economic policy, I think has been pretty, it's been pretty disastrous, maybe in less hyperbolic terms, it has been pretty poor, because top-down policies, I think, pretty clearly do not work, no matter how much we try.
Okay, let's change the subject slightly, but keep the theme of centralization and top-down policies. You have I'm not sure if it's yours or Nasib Taleb's fat tail principle about markets, and me particularly, I'm interested in market instability.
Sure. So I recently wrote this article. I've written a couple of articles about kind of centralization, and I use the term stability and instability, but really better words for it are resiliency and fragility.
Okay.
So investment market resiliency, financial system resiliency, and this concept of centralization. Now, I don't necessarily think it's Taleb's, but it is a very broad principle. Actually, the more I've researched it, it relates to computational sciences, it relates to economics, it relates to biology, it relates to ecology. It really it's a very broad principle, and the principle is centralization creates fragile systems, and decentralization creates resilient systems.
Why? I'd like to know exactly why.
And the reason why is, it really kind of goes back, we can apply it to macroeconomics, that whole principle of macro versus microeconomics is that when you look at systems, so now this is a systems analysis. So this is by definition a collection of individual things, right? And specifically the relationships of individual things. So when you look at how individual things relate to each other, there are dependencies, there are causes, and there are effects. And what you see is when you have an effect tied to a cause, to a single cause, that is a very fragile system, right? Because if anything in that cause breaks down, your effect can no longer happen, right? Because you have a single cause of an effect. That would be a centralized system. We could look at something as compare that to a decentralized system where you can have many causes for an effect to occur. In that scenario, a decentralized scenario, if one cause breaks down, you can still get an effect because you have diversified your causes away. Now that is pretty abstract. We can think of it in so let's maybe use a couple concretizing examples. So one example that I think about is like a manufacturer. Let's say you have a widget maker. The widget maker has one plant, one customer, one product, and one supplier. The whole operation is geared to making the one product for that one supplier, for that one customer, and it uses one supplier. Well, that is that manufacturer can be very efficient because it only has one thing to worry about. It has one input to worry about and has one output to worry about. So it can get economies of scale and hence lower costs on the input, and it gets economy of scale and less, and be more efficient on the output because it could get specialized equipment. It could run its plants very efficiently. It can, get its transportation costs, economies of scale there and make that more efficient. So it would have very high profit margin if you're looking at this widget maker. However, you could see how fragile that system is. What if the supplier has a problem? Well, then the widget maker can't run. What if the customer has a problem, right? What if the customer goes out of business, demand changes, at the customer or whatever? Well, then the widget maker has a manufacturing plant, but it has no customer. What if something happens at the plant? What if, a tornado strikes it and the plant is damaged or an equipment breaks down, right? Then that manufacturer cannot manufacture a widget. So while it would have a very efficient operation, it would be very fragile. Be very susceptible to any type of shock in the system. Now you can contrast that to let's say a decentralized widget maker. Decentralized widget maker would have many customers, many plants, and many suppliers. So let's say a supplier can't deliver. Well, okay. Well, that would be a problem. But there would be other suppliers there, other plants, and other customers, and the widget maker could maybe deliver less. Same thing on the customer side. One customer fails, one customer doesn't want the product. All right, there are other customers. Looking at the manufacturing side, one of the plants, blows up from an explosion. There are other plants to make the customers. So while problems on the decentralized widget maker would still be problems, they wouldn't be catastrophic. In other words, the widget maker would still be resilient. That's an example of sort of resiliency and decentralization and fragility and centralization. And we could apply that to, a lot of areas throughout the financial system. Because the financial system is just a system. And the same thing would apply to like an ecological system. So like in ecology, there are these concepts of food webs. Food web really just traces the dependency of organisms on each other, and specifically from a food perspective. So let's say you had, a swamp. I don't know. I'm going to make this up. Let's say you have a swamp ecosystem, and in the swamp you have algae, and then fish eat the algae, and then you have bigger fish eat the fish, and then you have alligators eat the algae, eat the bigger fish. So here you go. You have this ecosystem of food. Well, if there's one algae, one fish, and one fish and one alligator, let's say, there's a disease that comes that kills off all the algae. Well, the whole swamp ecosystem dies because then the fish don't have any algae to eat. They die, and then the alligator dies. Now, let's say you have a swamp, same chain, but there's many different type of algae, such that one algae dies. There's still other algae for the fish to eat, and so on and so forth. So that's another example of sort of decentralization versus centralized systems.
I'm thinking So this is something I'm familiar with. I'm wondering if I should add a layer to this. So in manufacturing, uh, there are all these sort of systems to reduce waste and make the process more lean. Typically, they will have like a one-to-one, or they'll try to have like a one-to-one relationship. So let's say on the production line, you have one machine, or like let's say four machines, but in a stream of one passing on to another machine, the same one. And when you have this sort of scenario, the manufacture plant itself is very predictable. And when it becomes very predictable, it becomes simplified, and you could tweak it and tune it to reduce again waste and improve the process. I think when you have like a decentralized system, it becomes more complex and more difficult to control from a central point of view. Like it becomes very difficult for like someone to control it. So let's say, for example, if you had a network of computers, and each one of them did something very different, and they're communicating with one another, and you don't know who said what to who, and how did they process that particular information. You can't trace in the system what is happening at any one point in time. But if you're an economy or an ecology, and each individual is making localized decisions, that could alleviate the problem of complexity, because from the point of view of the local individual, they are only receiving like a very specific amount of information, and or let's say in the sense of money, like they need to buy groceries, and they receive from their salary a certain amount of money, so they can make local decisions for themselves the best way what they can do. But if you had to plan a much larger economy and say who gets what food, then it becomes much more complicated and practically impossible, I think.
Yeah, and there's a trade-off there, because the centralized systems, right? Let's say on a manufacturing level, like you said, it would be way more efficient, right? Like efficiency increases, right? It would be more efficient to have like one language, right, or one policy, to use your examples. Things are easier. So the diversity, the decentralization adds complexity to it that makes it less efficient to manage, but it adds resiliency. So, there are trade-offs, and and it's not saying that one, it's really important to realize that like centralization and decentralization, one is not better than the other per se. It's what application, the application needs to dictate how centralized and decentralized you are, because the application has to dictate how important resiliency and fragility are. And when we're talking about something like the financial system,
you want
resiliency,
yeah,
is extremely important, right? An economy, right, is extremely important, and that's why centralization is bad, in my view, because it makes it more fragile. And in my view, when we're looking at the current state of the investment markets, the current state of the world economy, where things feel so fragile right now, I believe that is a symptom of the centralization that we've seen over the past, decades. This isn't just past 2 years. This isn't just, since the great financial crisis. This is going back, this is an evolution of centralization and decentralization throughout all of human organization. And when I look at the current state of the world, it has become more highly centralized than it has been, in a long time. And that relates to central banks being in the investment markets, right? Them buying bonds and manipulating interest rates is one way in which central banks centralize financial risks. They do that because they are in the market, and they are essentially trying to override, the decisions of what thousands, if not more, of investors are making, right? Investment markets are just financial transactions between individuals. And when the central bank comes in and tries to change those in a certain way, which they do by buying bonds, which they do by setting interest rate policy in the US. Here in the US, the Fed achieves its interest rate policy by literally buying and selling bonds, short-dated notes. So by intervening, they are actually they are centralizing the markets because they are overriding the decisions of many in order to put forth one decision. So central banks are centralizing. But also we've seen this in global economies and supply chains where companies, for better or for worse, have tried to make their operations more efficient. By doing that, they've outsourced more, and specifically like to China and Russia. For China, for cheap goods and services, and in Europe, for European listeners, they'll know that, pretty acutely for energy, right? And because Russia was able to provide cheap energy, we stopped energy development because we were able to rely on this efficient source of energy in Europe. Same thing for China. We stopped producing in other parts of the world because we went to centralize these operations in China. And that could be perfectly fine because it improves efficiency. But now what we find is when we have a change in political environment, we have a change in China, we have a change in Russia, where now those systems, the fragility of those systems now show. We can no longer rely on China or Russia to the same degree that you could, before. And now those systems are breaking down. And you're seeing that reflected in the investment markets, in my opinion. And the same thing has happened with central banks. Central banks had kept interest rates low by physically intervening in markets. And now they're doing the opposite by they're still intervening in markets, but they're physically selling now. And that is having, pretty big impacts because both of those actions have centralized both the economy and the markets, respectively, to certain degrees. And as a result, they've become more fragile and less resilient.
Would you say that? So when you say they try to make it more efficient, it seems to me that they try to make it more efficient for their own benefit. It's not efficient for the economy. It's just that they're incentivized to, or central planners or central banks are incentivized to make things easier for themselves, so they have more control over things, and by doing so, they make things more fragile or less robust.
Well, I mean, take maybe less of a personal view on it, in that central bankers, like, or a less nefarious perspective, is like they're just doing what they think that they should be doing. So, they think that this is how they should act. And it's not a matter of efficiency or not. This is kind of the mandate in the world that we live in, which is just, I think, an incorrect incorrect. So I don't know that it's self-serving so much. It is self-serving, right? But what isn't self-serving? Right? Every organism is self. Yeah.
I'm not trying to be nefarious. I'm just saying they're incentivized.
The incentives. Yeah, I mean, the incentive structure for a central bank to act is going to be for the central bank. Yeah. And a central bank. So, like, in my view, right, if you really wanted to have the central bank stabilize markets, the right thing to do would be to decentralize, which would mean not in one step, but ultimately it would mean disbanding a central bank and go back to a decentralized financial system. Now, what central banker, to your point, is going to go up there and be like, we should disband, right? That's not what they're hired to do.
Right. I guess I'm thinking more in the sense of governments rather than central banks, I suppose. So if, let's say,
same thing.
We don't want people to do a certain behavior, so we pass a regulation. Let's say we want there to be more restrictions on energy production because we believe it has a negative effect for some reason, and we want more restriction on it, and we do it so we as the government can control more of this particular element of the economy, so we can worry less about it, or we're incentivized more to make it easier for both ourselves and people who are concerned about it in the political system, let's say. So it's not necessarily nefarious in the way that I imagined it. It's just, look, this is the easier option out of the two. It's like I'm if I went to the energy suppliers and say, pretty please don't do this, they may not do this. But if I tell them do this because I'm forcing you to, they'll definitely do this.
Yeah, I think that's right. And I think, for the most part, but I mean, you can look back at government, for example, and there are rare times in history where they do step back, right? Look at, maybe Margaret Thatcher in the Reagan era, right? Where there were more moves towards freedom. Look at the founding of America, right? That was a decentralizing perspective. That was a government rejecting, or maybe, I guess a revolution. But really, it is sort of the founding of a government that is rejecting the ideas of centralized control. So I think there are historical examples of governments giving up control. But yeah, to your point, they're rare, extremely rare, and I think it's sort of inherent in the problem. Where it takes a culture of recognizing this and wanting to become more self-sufficient, more resilient, and more decentralized.
I think that's why you need the.
Yeah, I think that is a cultural and philosophical problem.
Yeah, absolutely. I think it's a philosophical and perhaps principled approach. Certainly, Margaret Thatcher, from my end, had a principled approach to a lot of the decisions that she made and chose to do what is right instead of what is expedient, I suppose. Steph, I think I'm gonna have to let you go because I think you are rushing somewhere else. But I really appreciate the conversation. It was really interesting. I do hope to have you on again, and thank you so very much.
Yeah, thanks for having me. I had a blast. I wish we could have. We should definitely follow up again. That'd be fun. These are pretty deep topics. They're pretty. They're very complicated. They're very deep. They're very abstract. So like they really require a lot of thinking to really work our way through, I think. So happy to hopefully this was cogent enough, and we be thrilled to do it again.
Excellent, thank you. So I'll say goodbye, and hopefully we'll meet again.
Sounds great. Take care.